About that all day yesterday.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Moments away from the start of trading, we see futures up across the board after the big drop that we had in the live trade, in the cash trade yesterday, and after yields came back down a little bit, giving tech shares a little bit of room to breathe. There you hear the opening bell, and you can see it there on the New York Stock Exchange and here on the NASDAQ. Let's switch up the boards and take a look at some of the other asset classes that we pay attention to. The euro dollar, 106.48 right now. Not a lot of change there. The 10-year yield also little changed, but still at a relatively high level, 447.63. And NYMEX crude back up above $90 a barrel after having dropped below that benchmark price yesterday. 91.13 the level for West Texas Intermediate. Now, one stock to watch at the open this morning has got to be Activision. Microsoft is closing in on its $69 billion acquisition after passing a final regulatory hurdle in the UK. Microsoft executive Brad Smith saying, quote, "We're encouraged by this positive development in the Competitions and Markets Authority's review process." Ed Ludlow is here with more on this big deal. Ed?
It's astonishing because at the beginning of the summer, anyone you would talk to would say this deal wasn't going to happen. Now, look at Activision shares, $94.10, 90 cents away from the $95 per share offer that Microsoft made. This is a $69 billion deal. The compromise that Microsoft and Activision put on the table was to sell the cloud streaming gaming rights to Ubisoft, a French independent video games studio and publisher. And from the CMA's perspective, the Competition and Markets Authority, that is good enough to maintain a competitive market to their mind. It's interesting because basically Microsoft and Activision went to regulators, the CMA being the final hurdle, saying the cloud market is a tiny nascent part of the video games industry. Why are you so hung up on this? But it's what they wanted to see. And Sarah Cardle, the CEO of the CMA, was on our programs earlier this morning saying this is a lesson learned. Next time would have been easier if you guys had just done this compromise to begin with. There is a consultation period through October 6th, but right now, based on the spread and all of the reaction to this CMA provisional decision, this deal is going through, and it's a big one for the video games industry.
Yeah, a big one. People care about Call of Duty as well. Ed, thanks very much for that. Some breaking news right now on Ford. We see the shares also popping in the pre-market. Let's get over to Abigail Doolittle with the details. Abigail?
Yeah, indeed, Matt. We do have the shares of Ford popping higher right now, up about 2.5%. The best day since early June. And this on a Reuters headline that the UAW is to announce progress made with Ford in labor talks. And of course, at 10 a.m., the UAW is expected to ramp up this very particular strike that they're doing, surgical strike that they're doing. But now we do, of course, have this headline that UAW has announced progress made with Ford in labor talks. The shares are higher, up 2.3%. We also have a sympathy trade in the shares of GM. They are also higher, so we'll be waiting for more here. But the idea, quote unquote, real progress has been made by the UAW with Ford. So it will be interesting again to see what announcements could potentially follow this, and if it also is a good sign for both GM and Stellantis. One other stock that is moving this morning, of course, Matt, is Amazon. This after the company has said that they, similar to Disney Plus and Disney ESPN and Hulu and some of those other streaming services, along with Netflix, they are going to be running ads on Prime Video in key markets starting in 2024. And of course, right now, Prime on a yearly basis costs $139. The cost to not have those streaming ads, $299 a month, which is less than Disney. I believe it's also less than Netflix. But these major streaming services, they are trying to bring ads into the service and then get people to pay extra to not have to have that. And just to return quickly, Matt, because you are a car guy, Ford right now at session highs, up 3.4%. The best day, again, I believe, since early June. And on this Reuters headline that the UAW head saying that real progress has been made. And we also have now CNBC reporting on that in addition to Reuters.
Yeah, it's interesting. Usually the UAW gets along with Ford best. The workers like that the company is essentially family owned, or, you know, in a sense, and that Bill Ford gets personally involved in those those negotiations, so typically they're friendlier. On the other hand, it hasn't looked like that over the past couple of weeks. We'll continue to follow these developments very closely. Abigail, thanks very much for that. Now, a big day for Apple. The new iPhone 15 going on sale in roughly 40 countries today. Dan Ives of Wedbush writing, quote, iPhone 15 pre-orders are still tracking much stronger than we and the street originally expected, and up roughly 10 to 12% from iPhone 14 based on our analysis. Katie Greifeld is here with the latest. Katie, did you get yours yet?
I haven't gotten mine yet, and apparently online reservations are hard to come by as well. But you take a look at shares this morning, up slightly as the iPhone 15 Pro and Pro Max models go on sale in this first wave. And Matt, there's at least two big tests here. The first one, of course, is what demand will look like for the new iPhone 15, and also can Apple fulfill that demand. Now, at least on the first point, there's plenty of early signs that indicate that people definitely want to buy this new phone. You take a look at new online orders for the highest end new models, and they won't arrive for customers at least until mid-November in several countries, rather. And while reservations for in-store pickups, they actually quickly sold out. So a lot of early indications of demand, and that's good news for Apple because there is a lot riding on this. These models will represent Apple's biggest sellers through the end of 2023 and are expected to make or break Apple's holiday season. Obviously very important for the iPhone maker. It's hoping to return to growth after a streak of quarterly sales decline, Matt.
All right, we'll be watching that. I saw lines outside the Apple store on Fifth Avenue driving in this morning already. Katie, thanks very much for that. Mega cap tech stocks flirting with one of their worst weeks of a pretty good year. Surging bond yields have kept pressure on some of the sector's biggest names. Mona Mahajan at Edward Jones weighing in, writing, quote, we expect some broadening in leadership as rates remain elevated and would look to complement growth in tech stocks with better valuation parts of the market. Cyclicals and, over time, small caps may play some catch-up. I'm pleased to say Mona Mahajan joins us now with more. Mona, great to have you on the program. I didn't see the word value there. Certainly not, describing that group of stocks. It's almost become a dirty word in this market because it doesn't seem to ever win out. What's the story?
Yeah, thanks, Matt. Look, I think a lot of the sectors that were mentioned there are part of the value complex. So to broaden it out to value more broadly, I think probably would also include some of the defensive parts of the market like healthcare staples and utilities, which tend to outperform in periods of a recession. And clearly this economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024. That is really an environment where we see the Fed potentially pausing and, as they've indicated, maybe pivoting lower. We see inflation continuing to moderate, and we could get a rebound in earnings growth as well. So that's a better backdrop for a balanced portfolio. Now, we wouldn't want to wholesale get out of the AI tech story. We think that's in early phases of a secular bull market as well. But we certainly think, given what's happened this year particularly, some broadening of participation, especially if we reemerge from some sort of period of economic softness, does make a lot of sense. We want to make sure portfolios are balanced, diversified, and have exposure to those cyclical and potentially small caps as well.
What are the cyclicals? I mean, do you like the automakers right now? It seems like a tricky situation.
Yeah, I think we have some headwinds ahead of us that not only with the UAW strike, of course, we have a potential government shutdown. We have oil prices that remain elevated, walls of worry that the market will have to continue to climb. But markets have looked forward in the past. They will continue to do so. So within the cyclical complex, we think industrials make a lot of sense, especially as infrastructure will continue to be built out here in the U.S. and globally. A lot of manufacturing is coming onshore across the globe. And so I think that'll be a trend that continues to play out in the next 12 to 18 months. Certainly areas like financials, which have historically been more levered to a better economy, could look to a period of better performance, but probably not till 2024, back half of 2024. And energy is the other part of the cyclical story that's already shown better performance even in this quarter. Part of that has already played out, but I think those three sectors in cyclicals we would continue to watch carefully. Think about consumer discretionary as well as we move forward.
Yeah, I was wondering about that. I mean, restaurants, airlines, hotels, luxury, how do you view the U.S. consumer right now as we get reports from places like, Darden, that its customers are choosing less expensive wine, although those aren't probably the same customers buying stuff from Hermes and Gucci.
Yeah, look, it's interesting. The consumer has been the backbone of this economy. They've been extremely resilient thus far. But we are entering this period. We're at the end of the summer travel season, and consumers are faced with not only higher oil prices, now an interest rate environment that may be higher for longer. And of course, we know they've worked down some of those excess savings that were given to them in the post-pandemic period. And by the way, credit card levels are elevated, and lending standards are tighter as well. So this is, probably some headwinds to consumption in the consumer in probably the 1 or 2 quarters ahead. We'd expect a bit of softening, not only in the consumer, but we're seeing early signs of labor market maybe cooling as well. So areas that had really held up well, will the next move be, better or some softening? We think probably some easing is likely. And so that's something to keep in mind, especially as we think about, earnings and growth in the months ahead.
What about rates? I mean, 4.5% on the 10-year, more than 5.1% on the 2-year. I mean, really, across the curve, you're getting a decent return, so that even if you don't see capital appreciation, which seems likely to me, you're still getting a nice coupon.
Yeah, Matt, you summarized it well. Look, with yields towards the highs of this cycle, in fact, of course, there is some intrigue in the shorter duration part of the market. Cash and cash-like instruments are giving an opportunity that we haven't seen really in recent history. But there is some risk there. If you're in a CD and you have to reinvest in the months ahead, you might have some reinvestment risk. You have to reinvest at a lower rate. But also you can miss out some of the interesting opportunities that are forming. And to your point, the bond space in particular, especially if we look at a little bit of a longer duration investment grade bond area, that could be really compelling. Historically, forward bond returns have been determined by where the current yield is. And current yields, as we know, are probably towards a peak. And you're not only kind of locking in these better yields for longer, but you have that chance, to your point, of price appreciation. If over time, the Fed not only pauses, they pivot lower, you really have this nice window for extending duration ahead of that move, to your point, price appreciation and locking in yields. It's a nice combination that you might be getting in the months ahead.
Mona, stick with us. Mona Mahajan there from Edward Jones. We're continuing to see breaking news come across the ticker on Ford. People familiar now telling Bloomberg News that the UAW is making meaningful progress with Ford. And of course, we're set to get an announcement from the union president at 10 a.m. on Facebook Live. And then he's set a deadline for 2 hours after that. Let's get back over to Kaylee Lines right now. She's in Washington, D.C. and has more for us on this developing story. Kaylee?
Well, Matt, you can see it moving the market already. Ford shares now up about 2.5%. If these gains hold, could be the best day for the stock going back to June on this news of progress being made with this one particular automaker. We will, of course, look for details from Sean Fain's live streamed event that is happening just about 20 minutes from now. But remember, there's still 2 other automakers at play here, GM and Stellantis, and we don't have news at this point of whether or not progress is being made on that front. So when we're thinking about the ways in which this strike could expand or not, which automaker could see more pain inflicted by the union. Ford shares, though, definitely benefiting from this news. Now, we did have a separate report also just moments ago from Reuters that the UAW was going to ask President Biden or invite him to come to the picket line. And this is really interesting, Matt, because, of course, as we've talked often about, President Biden has billed himself as the most pro-union president in history. He's come out on the side of the UAW workers, even though he says no one wants a strike. But also we have to consider that next Wednesday, on the evening of the second GOP primary debate, President Trump, former President Trump, is going to be counter-programming that debate by being in Detroit and addressing the UAW. So it'll be really interesting to see if we have the former president and current president, who right now are the front runners of each of their individual parties in the 2024 race, showing up at the picket line. But as for Ford in particular, right now up about 2.25%. We'll look for more details on that progress from Sean Fain just a short time from now, Matt.
All right, Kaylee Lyons there covering the developing strike story for us out of Washington, D.C., and obviously it's very closely related to the political story as well. So she's an excellent person to get updates from. Coming up, fresh economic data rolling in. We're breaking the latest U.S. PMIs after a little bit of a disappointment out of France and Europe. This is Bloomberg.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That's former St. Louis Fed President Jim Bullard speaking yesterday with Mike McKee on the U.S. economy. Breaking PMIs crossing the terminal right now. Let's get over to our international economics and politics correspondent, who is actually sitting right next to me there.
Yeah, not overseas, but we do have numbers both in the United States and overseas, and the U.S. is not Europe. We can say that. Global manufacturing on the S&P manufacturing index for the PMI, 48.9. That's up from 47.9, still a little bit below the 50 break-even point. But services and the composite for the U.S. remain above 50, 50.2 for services, 50.1 for the composite. Those are down a tick, but they do show still continued growth in the U.S., and that is a completely different story, Matt, from what we see over in Europe. You take a look at France, Germany, the Eurozone, and the UK all reporting today those global, those S&P global PMIs. And look at all the 40s. There are no 50s there. And in Germany, rather, you see 39.8 for manufacturing. Germany, the only one of those countries at this point forecast to actually go into recession by economists surveyed by Bloomberg. But the UK very close to it. And of course, the Eurozone itself is struggling with manufacturing. You look at those numbers, and it is definitely not the U.S. We'll see what the Fed thinks of these numbers and what the Fed thinks of what the Fed did, because today we get a lot of Fed speak. The blackout list today, Lisa Cook is speaking, Mary Daly and Susan Collins are speaking, all this coming up after 10 a.m. this morning, and Neil Kashkari later this afternoon. So we will get some idea of whether the markets are reading the Fed right and what they decided the Fed is going to do after the decision on Wednesday.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television's international politics and economics editor. Mona Mahajan is back with us. And Mona, you know, what's your take on, I guess the PMIs here are pretty much in line with expectations. The French PMIs I saw disappointing, and Europe looks like it may be contracting. How does the economy look to you?
Yeah, you know, it's interesting when you look at the dichotomy between manufacturing and services. Of course, manufacturing had been in a downturn, and now we're starting to see a bit of stabilization, even a tick higher. And services, which had been driving, you know, the U.S. economy, looks like it's heading towards a peak. And so this idea of rolling downturns, or some call rolling recession, could still be in play here. You know, parts of the economy that had originally really kind of gotten hit hard by the Fed rate hikes are starting to see signs of stabilization. You can maybe even put housing in that category, and services, which, you know, had kind of chugged along, may now start to stall a bit as we're heading towards these peak rates that finally, you know, may catch up with that lag impact that we've all been talking about. And so we do think that the U.S. economy could soften, but probably not, you know, heading towards any sort of technical recession, but a period of below trend growth. And even in the Fed projections, you know, the 1.5% for 2024 could imply a softer first half followed by a rebound in the back half of the year. And I think that to us seems like a credible backdrop.
In terms of next year, you know, so many people have been saying we're going to see double-digit earnings growth come back again. I guess you have to be in the soft landing camp to believe that. But if we do get sweet economic growth in the U.S., why do you think the Fed would cut rates twice? What's the catalyst?
Yeah, it's a great question. And, you know, look, I think with rates here, even at 5.25% to 5.5%, still highly restrictive. And if you think about inflation perhaps continuing to moderate, you know, even in line with their own projections, that brings the real rate, you know, the nominal rate minus inflation, even higher. Even if the Fed just, you know, keeps steady at this pace on pause, real rates, which do impact the economy and do add a bit of tightening, continue to move higher. Now, if they do believe that a neutral rate is closer to 2.5% to 3%, and if inflation continues to moderate, do they need to stay at such a restrictive level for an elevated period of time? And so I think over time, the way they would probably communicate it is they're going to start normalizing rates gradually back towards a neutral level. And so that could be where you get the signal of 1 to 2 rate cuts next year. We think that is a credible scenario. If the economy softens more than they expect, you know, the original scenario of 3 to 4 cuts may be back on the table as well. But for now, I think a normalization out of this, you know, highly restrictive territory is probably the path of, you know, most credible for now.
All right, Mona, thanks very much for joining us. Mona Mahajan there from Edward Jones. Let's get some sector price action this morning. For that, we go to Bloomberg's Abigail Doolittle.
Yeah, Matt, very quickly, we are looking at a rebound rally for the S&P 500. So we have more sectors higher than not, led by energy. Interestingly enough, we have some of the rate-sensitive sectors on bottom, such as utilities and real estate and healthcare. Even though rates are lower, those dividends should look better. That's not the case. On the week, though, let's take a look at the week. The S&P 500 right now heading to a decline of 2.5%, the worst week since early March. Here are the two best sectors: defense, so that's risk off, and then the two worst sectors, real estate and consumer discretionary. Rough week for stocks, third week down for the S&P 500 in a row, Matt.
All right, Abigail Doolittle, thanks very much. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Matt Miller in for John Farrow. Time now for the trading diary, what you need to be watching through the next week. UAW President Shawn Fain making an announcement on Facebook Live, this coming amid fresh reports of meaningful progress just in the last 30 minutes in the UAW's negotiations with Ford. That announcement on Facebook Live at the top of the hour will bring you all the headlines. Plus, more Fed speak from Mary Daly and Neil Kashkari. That's at 1 p.m. New York time this afternoon. We get U.S. GDP next Thursday, plus more Fed speak from Goolsbee, Barkin, and Chair Powell. And finally, the government shutdown deadline coming at midnight on September 30th. This is Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 22nd. Here are the top market stories that we're following for you at this hour. Party like it's 2007. You got long-term bond yields hitting a 16-year high overnight. And now take a break while the S&P pretty much goes nowhere after the recent slide. And measuring PMI pain. U.S. holds up. Euro area, UK PMI is pretty bad. We're going to get instant analysis with Chris Williamson of S&P Global Market Intelligence. And auto strikes rev up. UAW could expand its walkout today after a week of no agreement. We're going to get you the latest. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it does feel that everybody's tired. And I'm not talking my book. I'm just saying everyone feels tired. Volume's really light. Just feels like everyone's taking a break.
I'm not sure everybody's partying right now with these higher yields. It feels like it's maybe the punch bowl being taken away. That's going to be the problem. That's going to be the impact that maybe these higher yields ultimately have on the economy. Susan Collins of the Fed giving some further comments on what is happening here. Further Fed hikes are certainly, quote, not off the table, according to her. The PMI data, I think, paints a really interesting picture today, Alex. Certainly a fairly bleak one for Europe. They have been pointing to a fairly bleak picture for a while, but the numbers just continue to get worse. In the States, less so.
Yeah.
So our question of the day is basically around how much pain do they point to? And it feels like the answer is very different depending on which side of the Atlantic you're on or which side of the Pacific you're on for that matter. So let's get some instant analysis. Chris Williamson, S&P Global Markets Intelligence Chief Business Economist, joins us to discuss this. If I'm Alex Steele over in America, the picture looks much better. If I'm Guy Johnson here in Europe, it doesn't look quite so clever. Chris, give me the instant analysis and how different that analysis is depending on where you are.
Yeah, it's an interesting way of looking at it, Guy. Certainly the European numbers, both Eurozone and UK, turning down in recent months. Some signs of maybe it bottoming out in the Eurozone, but forward-looking indicators like order books, they're still turning down really quite sharply. So more pain to come. So the upshot is you're looking at signals of Q3 GDP declines, both for the UK and the Eurozone, with that weakness persisting into the fourth quarter. US, on the other hand, is fairly stable at a pretty miserable level, mind you. We're pretty much stalled. So we had a good growth spurt up to July, really, which seems to be fading now. So you might get a good GDP reading for Q3 in the US, but I think Q4 is going to look quite different. So there's just a delaying the pain, really.
That was some cool focusing that just happened on your camera. Chris, delayed pain, does that mean that we're going to see U.S. PMIs roll over to the extent that we've seen in Europe and the UK, or will the U.S. always in some ways outperform?
I think the US will outperform. We've had obviously big drags in Germany from the energy price hike. We're seeing that in manufacturing. One of the reasons why the German manufacturing numbers are just so weak. There's been a structural hit, if you like, to the German factory sector, which it's still reeling from. And the US, in contrast, is investing a lot of money in expanding new production facilities with the new acts that Biden's brought in. So I think the prospects for manufacturing in the US are looking a lot brighter than in Europe at the moment. That's a big factor to help. The other side of the whole economy, of course, is the services side, where we're seeing this synchronized weakening of growth from consumers that have been hit by the increased cost of living and higher interest rates in the US and Europe. That's really beginning to take a toll now, so it's going to be a key thing to watch as we go forward, just how much households are being hit by that element of that headwind.
Chris, the Bank of England apparently saw your data before it made its decision relating to pausing its rate hiking cycle. What within that data do you think would have caused them to pause?
Well, for a start, the weakness of the activity levels, then that's also translating into a sudden, quite worrying downturn in hiring. The job market, as we all know, has been fairly resilient, and that's helped keep this wage growth up. But one of the things central banks are looking for is the labour markets to start weakening and to start reducing that wage bargaining power. And that's exactly what you had in September with those PMI numbers. That's coming through really quite clearly now. But then the other side of it was a sharp reduction in price pressures as well. So although we had higher prices for energy, notably from the oil price hike, that doesn't seem to have cut through. There's other forces at play here, and this is this reduction in pricing power firms have got. So their costs may be rising, but they just can't pass it on.
And this also goes to maybe the employment part as well, because what I thought was interesting was in the U.S., you're still seeing employment growth, and that quickening, versus in the U.K., for example, or Europe, where it's not. Walk me through the why there.
Yeah, well, this is about labour market supply, first and foremost. So, yeah, job growth actually picked up in the US. Now, you've got more people starting to struggle with the cost of living and interest rates, and they're coming back into the labour market, which means some of these long-standing vacancies can be filled now. So this is helping support those numbers in the US. The question, of course, is how long will this persist for? Even in the US, we've got backlogs of work falling sharply now. Companies are going to start looking at their workforce numbers soon if that persists.
Chris, what is the message on inflation?
The inflation, it's stickiness, stubbornness, around the 3% mark. It's not faltering yet. Again, let's watch those labour market numbers. That could help bring it down. Against that, you've got the oil price rise. The overall picture is sort of stuck at 3%. This last leg down to 2% is still looking really unattainable.
Chris, always great to catch up. Thank you for the instant analysis. Chris Williamson, S&P Global Market Intelligence Chief Business Economist with the PMI data. Let's turn our attention to another event that is happening right now. We're expecting it to happen right now. We can't see that it's started yet. The UAW President Sean Fain, we understand any minute now will hold a Facebook Live event. He's going to be updating on the negotiations with the automakers and potentially updating us on where the strikes are going to progress to next. People familiar with the matter apparently saying that the UAW is making, quote, meaningful progress with Ford. Where does that leave everybody else? What are we expecting over the next few minutes? Craig Trudell joins us now. This is his wheelhouse. You're behind the driving wheel of all our coverage here on autos. It hasn't started yet. We understand Ford is making progress. What are we expecting to hear?
Yeah, importantly, that language around substantial progress was the sort of bar that the UAW said just a few days ago was what these companies were going to have to clear or else the strike expands. And so I think, we have not been able to confirm this just yet, but the expectation is that Ford may be, kept at just one factory for the time being. With GM and Stellantis, it may be another story. We have not gotten an indication that substantial progress has been made. With each of those companies, it's just one factory that's been down for about a week, as has been the case with Ford. The expectation there would be that we would see some additional plants struck as a result of that lack of progress.
So it looks like the Facebook announcement with Sean Fain is indeed starting. Craig, if we do see progress with Ford, don't the others kind of have to go along? It's going to be hard to make a deal with one and not the others around the same kind of terms, right?
Ideally, we'll see some, I guess ideally if you're a car maker in Detroit right now, we'll see some semblance of normalcy restored here because this is how it has always worked in the past. You've had the union sort of, settle in with one car maker, hammer out a deal, and then try to use that deal to sort of leverage agreements with the other two. And even if it's one at a time, or at the same time, in the past, that's the way this has gone. I think the very unique aspect that we've seen here is the UAW sort of rip up that playbook. The UAW president, Sean Fain, has actually, thrown offers in the trash in a sort of show of his frustration with the offers that have come in from these companies. And that's not the only way that he's sort of thrown out convention in the way that he's approached negotiations with these companies.
It looks like some sort of video is playing. As soon as we get to Sean Fain, we'll bring you the news on what he is going to tell us about where we progress from here. What is if the strike is going to progress, where is it expected to progress to?
That's one of the sort of uncomfortable facts for these companies is they don't know what the union's next move is. Yep. I think, generally the expectation, if I were a betting man, would be assembly plants because parts plants are unlikely to be a sort of good place to take those out because that will leave lead to other assembly plants going down and potentially lead to layoffs that the UAW would have to sort out, strike funds going to those plants anyway.
All right, Craig, thanks a lot. Super appreciate it. We're going to bring you back further if we have more updates. Coming up, we're going to get to our question of the day, but I do want to take you now to the UAW Auto Workers President Sean Fain, who's speaking on Facebook. Here's kind of what he's talking about.
Region 1, 400 workers at Lear, the auto parts supplier, just joined Local 155. President William Verdier and Recording Secretary Sylvanus Thomas worked hard to help bring these workers into our union. From auto to higher ed and everywhere in between, our union is organizing, growing, and building our power. It's not just new organizing, it's on the picket line too. Our 1,400 UAW members at Blue Cross Blue Shield of Michigan just marked a week on strike. For years, the insurer has been outsourcing their work. Our UAW family at Blue Cross Blue Shield was once 5,000 strong. Today it's shrunk down to just 1,400. And the workers that are left are stuck in a tiered system where it takes 22 years to get to top pay. Our members have said enough is enough, and they are being strongly supported by Secretary-Treasurer Margaret Mock, Region 1A Director LaShawn English, and Region 1D Director Steve Dawes. They are all working together to raise awareness and build public support for this critical fight.
This economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024.
That was Mona Mahajan, Senior Investment Strategist at Edward Jones, speaking earlier on Bloomberg Television. So it leads us to the question of the day. How much pain are the PMIs predicting? They tell different stories, varying degrees of pain in the UK, Europe, as well as the U.S. And then how is that reflected in the markets? Kathy Entwistle, Morgan Stanley Managing Director, joins us now. Kathy, how much pain are the PMIs predicting and where?
Yeah, every time we see the PMIs go down further, it's just showing us that there's going to be more issues that are coming and that we need to be concerned. So a lot of times these numbers that we're looking at across the board when we're looking at the economy, we're trying to figure out where we're going. And again, these will help us realize that the reality is there are issues in the markets, there are issues in the economy, and even though we've been seeing such a great trajectory of growth stocks in the markets, overall there's issues to come, and we have to think about them and know that we need to position ourselves properly to manage our portfolios against that.
Kathy, the big story out of this week has been central banks that have paused. We've had PMIs that are pointing to slow down, or at least sort of not stagflation, but stagnation at best. Yet you look at what is happening in the bond market and the yields that we're seeing and the climb that we've seen in yields this week, and it doesn't all add up. How do you put all that on the same piece of paper and make it kind of connect?
Yeah, that's interesting. It's almost like a tale of two cities. We're looking at inflation, and there's some inflation that's coming down and some inflation that's going up. We're looking at, the PMI numbers, and we're looking at the services that are, underlying that. And it really is very typical of where we are in the cycle. We're sort of in the late cycle of this market. And we should see some relief eventually, but we're not going to see it yet. And I think as long as you're aware of that and you look at opportunities to take advantage of, low points and buy at those times. That's how you manage your way through the market in terms of spending and the reality of that we're all consumers, and how are we going to get past these high costs and high prices, and will people still pay to travel and things like that. I think we're going to see some pain there.
Well, okay, so as an equity investor, let's just say, take the equity market for instance, because what I found so interesting about the PMIs and then the reaction in the equity market was the lack of. Sure, we're a little heavy over in Europe, sure, we're holding up okay here in the US, but no real movement, right? So I'm just wondering, is all the bad news already priced into Europe to some extent, but it's the US that has more to go?
That's a great question, Alex. And I would say that when we look at the markets and where the opportunities are, we think Europe does have a little bit more advantage because the valuations are lower and there's probably more opportunities there where, yes, the U.S. probably has more to go. And as we all know, the way the market has been running, it's really been based on just a few key stocks. And there's a lot of underlying stocks that are not performing quite as well. And those also might be the stocks that are the opportunities for clients going forward.
Why would I want to come out of cash, though, right now, Kathy? As you say, we're at a really difficult juncture. We're trying to read the market. It's a struggle to read the market. This week, bonds have gone down, stocks have gone down. What do you do with that? Do you just sit in cash, wait, watch, see what happens, and then make a decision when the chips are kind of easier to read? How do I play this?
That's a great question. It's tempting to stay in cash because you are getting that 5% return, which seems a lot more positive than some of the markets that we're seeing with bonds and stocks, especially in the last week. However, we have to think long term. We have to have more of a disciplined approach. So we don't want clients to be out of the market. We want them to be in the market, but more focusing on the areas where there might be more opportunities, more defensive type companies. And also when you think about growth stocks, look at growth stocks at a reasonable price. Look and make sure the valuations are reasonable. And you can also look at dividend paying stocks, but also look at dividend paying stocks that are growing their dividends because that's showing that they have some opportunity to increase the value of their company as well. So looking in those areas are a little bit, I guess, smarter right now than others.
So Kathy,
dollar cost average too. Sorry, Alex.
Yeah, no worries. Dollar cost average, you gotta love that one. But that seems to me like buy consumer staples and buy AI tech stocks on the dip. Is that a fair assessment?
Yeah, healthcare, financials, energy, and buying the markets on the dip for sure.
Yeah, but in terms of my risk tolerance, am I big risk averse right now? Am I in defensive mode? Am I in wealth preservation mode right now, Kathy, rather than trying to make money?
Yeah, you should be in defensive mode. First of all, you want to protect the money that you have. You want to protect your investment. So you want to be in areas that are more defensive. And you don't want to be overly aggressive. Interestingly enough, we're finding that, maybe 10 years ago, we would have clients in portfolios that were the old, 60-40, 60% equities, 40% fixed income / cash-like investments. And we're actually bringing down that allocation to equities, not expecting more than, we're not expecting more than high single-digit returns over the next 10 years in the equity markets. It's not going to be like 2011 to 2021. So you have to be thoughtful and you have to be selective about where you're putting your money.
Kathy, great to catch up. Have a great weekend. Really appreciate the time as ever. Thank you very much. Kathy Entwistle, Morgan Stanley Managing Director. The Sean Fain event is still ongoing. He continues to update and brief as to where the UAW is going to be moving next. He talks about the fact that GM and Stellantis still need a serious push. He talks about the fact that there has been progress with Ford. It looks like they're making the most progress with Ford. So this is what's going to happen. The UAW is going to expand its strike action against GM and Stellantis. It is not going to do so against Ford. It feels it needs to push Ford a little harder, but progress is being made there. Clearly, it feels it needs to push GM and Stellantis much harder, and as a result of which, the strikes will be expanded. We'll continue to follow this event for you. This is the Facebook Live event that is taking place right now, and we will continue to keep you abreast of what Sean Fain is saying and the implications for the auto industry and the US economy. Still ahead, we need to talk about what is happening in the tech sector. Microsoft, Activision, that deal could actually happen, the deal edging closer in the United Kingdom. This as UK regulators signal they will accept Microsoft's latest, quite substantial concessions. Details of that next. The startup is coming. This is Bloomberg. Alex, we probably need to go back and check in on what is happening with the UAW update. Sean Fain updating us now on what is going to happen next. We are going to see a significant expansion of the strike. The strike is going to be expanded to 38 locations in 20 states. This is at GM and Stellantis facilities. Ford, where progress appears to be being made, we're not there yet, but Ford is going to be spared that expansion.
Yep, and you can really see it also in the stock price. Ford is holding up okay. That stock up by about 3%. GM kind of rolling over here at neutral. Stellantis, though, still holding up by 0.6%, but off its highs. But very clear, like we're not done yet, but definitely obviously making the agreement that as they inch forward, that things can go the car makers' way as well. If they give a little, then they get less strikes, I guess. But Stellantis and GM definitely not done yet. I do wonder, though, Guy, if they do, as I mentioned before, if you do make a deal with Ford, is that just going to be the deal for the other car companies? Is there a first mover advantage when it comes to making a deal with the union?
Probably, yes. Ford has traditionally had better relations with the UAW, so that may be kind of the easier part of the narrative. maybe the others are going to hold things up. They are going to fight a little bit harder. So maybe they don't just take the Ford deal and say that's what we're going to do as well. Maybe they're actually going to say, you know what, we're going to take a different view. We're going to take a different stance on this. As I say, better relations with Ford traditionally with the UAW. Let's talk a little bit about what is happening as well with the Microsoft Activision deal, because you're certainly seeing an impact in share prices around that. Probably time to take you to the startup. Ed Ludlow covering this story for us. Ed, let's talk about the deal that looks like it's going to be done in the UK that may get this deal over the line. So the UK regulatory authorities had held this deal up, but there's been a big concession. Does this kind of show that maybe the UK authorities were right to push a little bit harder?
It's so funny to say a big concession, because the point the CMA made, and Sarah Cadell on the show earlier, right, was like, why didn't you guys just make this offer at the beginning? If you'd done it at the start, you wouldn't have incurred the costs of negotiating that you had. But the compromise is to sell cloud gaming rights to Ubisoft, a French independent studio game developer or studio, and that has satisfied the regulator. And you know, I can tell you that both Microsoft and Activision were very frustrated that cloud gaming was even the point of contention, because it's such a nascent and small market. But some strong words from the CMA on Bloomberg Television earlier. It was interesting.
Yeah, I have to wonder, are there other deals that could now come to the foreground if they do a little bit of negotiating here now?
What's so funny about this deal is Microsoft bought Activision for mobile gaming and the metaverse, right? That is what King Studio at Activision is good for. The getting hung up on the cloud kind of really had nothing to do with Microsoft or Activision's motivations. But again, the political context here is so interesting. This is post-Brexit CMA, right? Go to the Bloomberg story and look at what the CMA chief said to us earlier. And it's basically like, this is a lesson learned that anyone that wants to do a big deal, that wants to avoid an expensive negotiation, come to us with the compromise that we asked for up front. It's pretty fighting talk, I don't know.
It is, it's interesting, and it looks like finally this deal may get done. Ubisoft, one of the big beneficiaries, certainly over here in terms of the share price reaction, could be one of the big winners out of this deal. Ed, I'm sure you're going to have some great coverage on this a little bit later on. Bloomberg Technology coming up in around 90 minutes' time. He will. Ed and Caroline, Bloomberg Technology a little later on. Sean Fain has just finished. We'll continue to keep you updated on that story next regarding the UAW. This is Bloomberg.
Great questions.
We're about an hour into U.S. trading session. I gotta say, volume is really light. It does really feel like everyone's exhausted from this week, and we're just taking a bit of a breather. Abigail's tracking the moves. Abby?
Yeah, real Friday feel. And this is a classic board that we would have taken a look at back in the day, led by the Dow. But you can see the Dow up the least, up 0.1%. The S&P 500 up a bit more. And then tech, the NASDAQ 100 up about 0.6%. So a little bit of a relief pop after 3 down days in a row on the hawkish pause from the Fed, or higher for longer. The idea that the system could be taken, some more money could be taken out. On the week, it's a different story. This is really, again, it's not even a relief rally, it's a relief pop. It'll be interesting to see if it lasts on the whole day. Here is the S&P 500 this week, down about 2.4%. Last time I looked, this was the worst week going back to early March, down for a 3rd week in a row. So the selling that we started to see back in early July, or excuse me, late July, right after the last Fed meeting, when they also delivered what seemed to be some sort of a more hawkish tone than what markets had expected. I think that they've been pretty transparent in this, but markets keep getting caught offsides. And that is, of course, resulting in yields trading higher. Take a look at the 2-year yield, up 5 basis points, but more importantly, the level up 5.08% earlier, closer to 5.15, and the 5-year at 4.55. That 10-year yield right now at 4.4% or so. Likely, I think it had touched 4.5%. Again, technically, we've been talking about the fact that now that it's breached above resistance, you could see an equal and opposite move back above 5%. Then the 10-year yield is the big loser on the week at a 4.53, but it's kind of amazing that you could have the 30-year trading below the 2-year. I mean, it's just really kind of crazy. In any case, if we take a look at the S&P 500 pricing all of this in, we've been watching this chart for a while. These lines, these fan lines, show that last year's bear market was reversing. Here's the range. For a little while, we popped out. It gave us some hope. This week, take a look at this. This is how bearish this week is. We are now close to the bottom of that range. The RSI on a weekly basis is moving lower. Alex, actually, this suggests that we are going to see this S&P 500 go, I would say, somewhere to 4250, but the bigger thing is, does this range, this ascending range, does it break to the downside? It is a bearish pattern, so again, this fall may prove interesting.
Yeah, and sort of what that catalyst is even going to look like. Abigail, thank you so much. Really appreciate it. So one catalyst could be oil. So oil prices trading around $94 a barrel, capping a very tumultuous week. The highlight was Russia banning some product exports, which is really going to tighten up that market. Christian Malik is JP Morgan Securities Head of Global Energy Strategy. He joined Bloomberg TV earlier today.
The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in oil, maybe last year briefly, that will drive $20 above the 80 to 100.
So that's the strategy take. Why don't we get the investor take? Ben Dell is Kimmeridge Energy co-founder and managing partner. Kimmeridge is an alternative asset manager focused exclusively on the energy sector. And Ben, by energy, I mean everything. You recently closed your latest E&P fund, so you do have oil and gas. You also do a lot of climate-related stuff as well, and you're working on some carbon management exchange things. So we're going to get to all of that. Do we get to $100 oil?
I think we do. I don't know if it's 2024. I think we're going above 100. I mean, fundamentally, what we're seeing here is a repeat of the 2000s in the sense that the upstream business is consolidating. Operators are not investing in supply. There's an underinvestment on the supply side of the equation. And ultimately, we're going to see the marginal cost of supply rise. And I think that'll continue to drive up commodity prices, both oil and gas prices, over the next 2, 3, 4 years.
How does the Permian react to that, Ben? If you see prices north of 100, the temptation to crack is going to be enormous. Now, the privateers will definitely do that, but what about some of the bigger companies as well?
I think you're going to continue to see discipline. I mean, 5 years ago, we saw the business model of the upstream oil and gas companies change from a high growth, no return model to a low growth, high return, distribute cash flow, improve balance sheets. I think the other thing that we've been seeing happening is a ramp up in M&A. And we saw this in the 2000s. We saw large cap buy small cap. The large cap operators are short inventory, and as a result, they're starting to accumulate and aggregate smaller companies. It started in the private space. We're now seeing it in the public space. Again, we saw that in the 2000s, and as we lower the number of companies operating in the space, I think you'll continue to see discipline associated with that.
So yeah, I mean, we've seen actually the private play, I mean, we've seen production kind of static. Do you think that's because the private players have come to religion here and are trying now to clean themselves up to then do some M&A with some larger guys, and are you into that?
I think it's fundamentally a change in the business model driven by an understanding that delivering return on capital employed and returning cash to shareholders is what shareholders care about right now. The second issue is there's a lack of capital in the space. If you look at private equity fundraising, the last 2 years have probably been the worst on record in probably 20 years. So there's really no capital to put to work from a private side. The cost of capital has gone up on a debt side. And when you look at the compression in multiples, the cost of capital on the public side has gone up. So I don't see that changing anytime soon. I mean, fundamentally, we've seen that capital move away from the space. I think if returns stay elevated, multiples ultimately expand, money comes back, and then we grow the supply base again. But that may be 4 or 5 years away.
Which 4 or 5 years we're supposed to be doing a net zero thing and like working towards that. So somebody mentioned to me the other day that what's happening in the alternative energy space in terms of, say, a capital suck is what we saw in shale back in 2015, 2016. We learned that the returns are a lot less. You have to plow in a ton of more money to even eke out those small returns, and we're kind of readjusting for that. Is that true? I mean, and if so, like, how do you, Ben Dell, invest in that space?
Yeah, I think there's a lot of analogs. I mean, if you look at renewable power, especially solar and wind, it's all been about megawatt growth, and it's not been about returns. And the argument you've heard is we're going to grow, we're going to get bigger, this space is going to accelerate. And I think what we've seen is a number of people make investments where the returns on those are low single digits. Now we have a higher cost of capital, and we're starting to see those companies' multiples compress because investors are realizing there's actually no value creation in that opportunity. I think what you'll see in the renewable space is what you saw in the shales in 2010 to 2020, which is that growth will decelerate, companies will consolidate, and the smaller cap players will get acquired. And we'll see better capital discipline, and ultimately those business models will also change. So I think it will come, but I do think you're seeing the parallels of the shale revolution in renewables right now, which is its growth at any cost.
Ben, one of the issues that we continue to have with the energy transition is we don't have a lot of frameworks in which we can operate. We don't know what the price of carbon is. We don't know what the price of anything is, to be honest, going forward from here. When is that problem going to be solved? Do we just adopt EU carbon trading? How do we fix the problem of commonality of the baseline from which the industry is going to grow?
Yeah, well, what we've said is that really everybody wants the same thing, which is low-cost power on demand with no carbon footprint. And if you look at that, you have your existing asset base, oil and gas, and you have carbon removal. And on the other side, you have renewable power, and then you're going to need to pair that with storage. And in the long run, what we should see is the price of carbon go to a marginal cost of renewables plus storage. Now, I think there's a huge path, decades long, of price discovery in that. We personally would love to see a carbon price. We think carbon markets are critical to success. And the reason I say that is what we've seen in the IRA is that if you create economic incentives, capital will follow. And when you really think about what a fully functioning carbon market will do is it puts a price on the emission, and it will bring capital to lower those emissions.
Right, because if you can't price it, then you can't invest in it. So unless you can show an investor, I'm losing this much money because of this carbon, I have to invest in it, it's not going to happen. So, but everyone wants to create a verified trading carbon platform. Like everyone wants to create the holy grail of like, I'm going to judge this tree versus this carbon management capture over here. You're also doing that. Is there room for all the players? How does this wind up if you're not all on the same platform?
There is. I think, listen, the carbon market will grow over time. We've seen it internationally. I think it will happen domestically. The fundamental problem with the carbon market right now, though, is transparency. If you think about carbon removal, what we care about is additionality. Have we taken carbon dioxide out of the atmosphere? And duration, are we doing it in perpetuity? When you think about that, it's really a mass balance. Whether someone looks at a tree or a new tree, whether someone looks at storing carbon underground, you should be able to measure and verify that you have stored the carbon and it's there in perpetuity. We're big fans of carbon removal credits. I think the market has got somewhat mired in this discussion about avoidance, which are counterfactual arguments about, well, this forest would have been cut down if I didn't do that.
Right.
And we need to see segregation between those two. We need to see greater transparency. And I think at that point, you'll see an acceleration in the market.
Before we let you go, LNG, you have an agreement with Commonwealth LNG. Any update there? Like, how big are you betting into the LNG U.S. export market right now?
We believe that fundamentally one of the best ways to remove emissions is to convert coal to natural gas. That substitution has been one of the biggest drivers in the U.S., and the U.S. has the ability to export gas into international markets and accelerate that adoption internationally. We have an upstream asset in South Texas. We're integrating it through to LNG, and we believe we can actually put LNG on the water with no net emissions on a Scope 1 and Scope 2 basis.
Wow.
So we're big believers in the growth of U.S. LNG. Well, we'll hopefully be doing that by 2028.
Okay, that'd be huge. Like green natural gas in just a few years is like that. No longer a bridge. Like that's going to be the real fuel going in. Ben, really cool stuff. Thank you for joining us, Ben Dell of Kimmeridge Energy. And next week, speaking of energy, I will be at the 2023 American Energy Security Summit in Oklahoma, where I'll be talking to the heads of Oxy, Devon, and Continental, plus a conversation with Nikki Haley, the former U.S. ambassador to the U.S. No, Guy, I am not bringing the hat.
Sorry. Okay, if you're gonna answer the question already, we could have some fun with that. But if you're ruling the hat out already, that's a huge shame.
It takes up a lot of space on the plane. Okay, ETR Friday's next. This is Bloomberg.